moving along, want to talk a little bit about Cathie Wood's ARC. Growth stocks have outperformed in the last month. I know you've pointed out to your subscribers over at Investor Place that some technical analysis shows Cathie Wood's ARC is forming an interesting pattern. Can you talk to us a little bit about what you're seeing there?
Sure. Yeah, I am trying to pull it up right now, but I will describe it as I pull it up. In technical analysis, there's something called an ascending triangle. And ascending triangles are when... So triangles are like a big thing in technical analysis. A lot of technical traders love to look at triangles. It's all about triangles because when a triangle converges, something big happens to that convergence. Now, what we're seeing in Cathie Wood's ETF, the ARC ETF, is we're seeing an ascending triangle. Now, an ascending triangle is, I just got the image, I'm pulling it up, and then I'm going to share my screen. Get that screen share going for you. Okay, let me know when it's on your when you can see it.
Coming in now. Okay. Yep. All right. I'm seeing this. All right. I'm seeing a triangle.
Okay. So here's your triangle. An ascending triangle is when you have this horizontal top. So your resistance line, you have this consistent line of resistance where every time the stock kind of tops out there, tops out.
Okay.
And then you have this increasing support line, this rising support line. So we top out, we come down, we top out, we come down, but we come down to a little bit less than when we came down back here. We top out and we come down back to a little bit less than when we came down here, right? So you have this increasing resistance line with this stable support line, the convergence of the triangle here. Normally, technical analysis says that once you get to this convergence point, you get a massive breakout to the upside. So this is the bullish ascending triangle that's forming not just in Cathie's ETF, but in a lot of her holdings and a lot of these growth stocks. And so I think that's a pretty bullish technical pattern that implies we're due for a short-term breakout in growth stocks. And I think that it lines up fundamentally with where we are in the cycle. Inflation fears have receded. Recession fears are now front and center. The Fed is done playing hard talk. They're doing hard walk. They're actually hiking 50, 75, 75. I think next week they go 75. Looks like 100 is not on the table, so they're probably going to 75. Anyways, that's 75, 75 back-to-back, 150 in a month. That's wild. The Fed is playing hardball finally. Inflation rates are finally decelerating. The growth to value ratio is finally rebounding after a complete plunge in 2022. Yields are coming down. We talked about this earlier. The 10-year Treasury yield front ran rate hikes up to 3.5. Now it's come down back to 3, and most analysts see it range bound in that lower 3% range for the next several years. I think it actually comes a little bit lower. So you are seeing this fundamental shift in markets where we're going into a recession. The Fed's going to kill inflation. Then what's going to happen, right? Markets like to look 6, 9, 12 months in the future. They're discounting mechanisms. So let's look 6, 9, 12 months in the future. End of 23, first quarter of 23, mid 23. What does the economy look like at that point in time? We probably have low inflation. I believe inflation falls from 9% today to around 3%, if not 2% by that point in time. You probably have a really slow economy because the Fed, in order to kill inflation, is going to hike rates very aggressively. That's going to kill the economy, or at least slow the economy dramatically. So you're probably going to have a really slow-moving economy with low inflation. That's a type of economy the Fed is going to stimulate with either rate hikes or maybe some QE. In that backdrop, a slow-moving, low-inflation economy with rate cuts, with potential QE, that's the 2010s backdrop. What happened in the 2010s? Growth stocks, ARC's ETF, tech stocks soared. They were the biggest winners. So I think we're moving back to that environment. I think this whole 2020, 2021, 2022 thing is like, it's this weird 3-year anomalous period that is now normalizing. The housing market's normalizing. We talked about that. I think the financial markets are normalizing. 2020 pandemic hit. Oh my God, weird. 2021, whoa, we got all this stimulus because of the pandemic. Boom, 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 boom. 2022, oh, we got to pay back for all that stimulus. Gosh darn it. Cycle's done. That cycle's done. We've ripped through this cycle. We had the massive crash, the huge stimulus, paying back for the stimulus, and now we're going back into a new cycle. So this cycle is almost done. And if so, that means we're going to be in a new cycle, early cycle in 23. What performs in early cycles? Tech stocks, growth stocks, the stuff that benefits from stimulative monetary policy, and the stuff that grows and helps drive growth throughout the U.S. economy. So I think this cycle is kind of run its course. We're nearing the end of it.
Okay.
As we're near the end of it, these stocks are going to soar. The technicals are showing us that right now. I believe a couple weeks ago, maybe it was last week, we talked about the breadth indicator, the number of NASDAQ stocks trading above their 200-day moving average, how it flipped below 20% to above 20%. 100% of the time, that leads to big rallies in tech stocks over the next 60 days. We're seeing the growth to value ratio rebound meaningfully. We talked about that. We're seeing really aggressive insider buying in tech stocks. So there really is this mountain of evidence piling up right now to support that thesis that this cycle, we've ripped through it, and we're about to go into a new cycle where tech stocks, growth stocks are actually the market's biggest winners. And I think today, before we started this call, let me pull it up. I mean, our growth stocks were rallying like crazy. And again, they're continuing to rally like crazy. And that's continued what has been a solid month of very significant outperformance in the growth sector. I think that continues. I think that persists. The one caveat there is the upcoming earnings season. I think this rally, this recovery is not going to be linear. 2 steps forward, 1 step back. 2 steps forward, 1 step back. I think this earnings season is going to be a pretty big 1 step back. Earnings are not going to be good. Companies are going to guide down. Managements are going to sound cautious, pessimistic. Earnings estimates, they're just now starting to come down a little bit. They're going to start to come down a lot. Against that backdrop, I think stocks are largely priced for it, but still, just the optics of it, you're going to get sellers into the market. I think we take a step back, and then we take 2 steps forward. So I do not think it's like, woo, off to the races from here, but I do think it's 2 steps forward, 1 step back with the earnings, 2 steps forward, then something's going to happen, 1 step back, 2 steps forward. We're going to zigzag, but we're going to zigzag up. And that's good. That's healthy. Straight line rallies aren't sustainable. Zigzag rallies, entirely sustainable. So I want to see that. I want to see 2 steps forward, 1 step back, 2 steps forward, 1 step back. The problem is we've been doing 1 step forward, 2 steps back, 1 step forward, 2 steps back. And I think that reverses.
So you guys are catching up to date.
And I think that reverses now. I think we do 2 steps forward, 1 step back, 2 steps forward, 1 step back. That's my school of thought. I think there's a lot of evidence supporting that school of thought. So that's where we are today.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.